Is Alphabet a wonderful company at a fair price? Now, Alphabet reported their quarterly earnings a couple of days ago. Numbers were very solid. Growth accelerating in a couple of important segments, profitability there as well. Companies buying back a lot of shares. So, why isn't the market liking this company right now? Because if we look at this company, yes, of course, amazing track records, right? Amazing growth, market cap $1.77 trillion. But if we look at the forward multiples here, forward PE, for example, 21.2 times. It is the cheapest out of the Magnificent Seven. Why is that? Why is it cheaper than Microsoft, Amazon, Apple, Tesla, Nvidia, Meta? Meta is actually the only one that is pretty close, even though it did jump 20% after reporting earnings. But still, a company like Alphabet is trading at the cheaper valuation than all the other big players. And if you look at the 5-year mean here, forward PE, EV to EBITDA, price to sales, price to free cash flow in the last 12 months, it's all cheaper right now. So what's the deal? Why isn't the market trusting this company to be at a more premium valuation just like the others? Well, that's what we're going to discuss in this video. I'm going to try and make my case, but still you're buying a company that is buying back an insane amount of shares, which means your shares will be worth more in the future. Free cash flow per share here has been increasing throughout the years. And who knows, maybe they looked at Meta issuing a dividend and also buying back a lot of shares. Maybe they'll announce the same thing. Who knows? But right now, you're definitely buying a business that is growing top and bottom line, that is buying back an insane amount of their own shares. But what are the analysts expecting for the coming years? Maybe that might explain the cheaper valuation. So as you can see, for fiscal year 24 and 25, sales growth of around 11% year over year, EPS growth around 15 to 16%, then fiscal year 2026, sales growth of another 10%, and EPS 13.42% year over year growth. So here you might say that, okay, maybe because in the coming fiscal years, this company will be or is expected to grow a bit slower than all the other big companies, and that's why we're giving it a lower multiple. Okay, could be. Again, these are just analyst expectations, not what the company will actually do. Sometimes they'll do more, sometimes they'll do less. So okay, that might be one reason why this is trading at a lower multiple than the other Magnificent Seven. The other reason will probably be, and that's just my opinion of course, is the CEO, Sundar Pichai. Maybe the market does not trust him as CEO of Alphabet to lead this company in the new age of AI. If you look at Zuck, if you look at Satya Nadella, Jensen Huang, for example, these are world-class top CEOs that have been innovating, that have been growing, that have been moving extremely fast. What has Alphabet, what has Google done in the last couple of years besides reacting to moves by other companies? In my opinion, not that much. So maybe that might be another big reason. But I want to show you more positive signs of this being not a dead company. More on that in just a second. If you enjoy this type of videos, leave it a thumbs up, subscribe if not. Would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So I want to start off with obviously the search engine market share worldwide. This is on desktop. Currently it sits just below 82% for Google, 10.5% for Bing. Of course, Bing has been taking some market share and Google has been losing a little bit of market share, but still the dominant player there. And this is desktop. If we move to mobile, we just have to laugh a little bit here because Google sits at 95.32%, Bing at 0.52%, Yandex 1.53%. So despite all the fears that ChatGPT, Bart will affect Google's dominance. Yes, I know Bart is part of Google, but still will affect their dominance in the search market. I think with 95.32%, they're still in a pretty comfortable spot. Then moving over, one of my favorite things, and this is my phone right now, and that's the Google Pixel. I'm very happy with this phone. I have a Google Pixel 8, the software, the AI capabilities, 4 pictures, 4 videos, really top notch for a very affordable price. And apparently, and this was released back in late 2023, Google Pixel sales reaches 40 million, 10 million in just 1 year. And that 10 million might not seem a lot, but it has been increasing year over year, or maybe generation after generation, and I don't see it slowing down anytime soon. For example, by 2019, Google's momentum picked up with 7.2 million units sold that year alone. I think we're going to be that with the Pixel 8 and Pixel 8 Pro. Now, why is that important? Well, Google controls the whole ecosystem. Google controls Android. And if Google can put more and more physical devices in people's pockets, they can do what Apple has been doing for years and years, right? Build upon that. Apps, financial services, advertising. Maybe Google at some point will not be paying Samsung and Apple to be the default browsers. They're paying billions and billions of dollars that flow into those companies' bottom line. Maybe one day they'll say, look, we think the Pixel phone is very, very successful. We think Google Chrome is already the default browser, even though they have to go into Safari, even though they have to go into Edge or Bing to download it. We think most people will still use Chrome, so we're not willing to pay you tens of billions of dollars each time for our browser to be the default one. We're not doing that anymore. Here you go. That will definitely increase Google's bottom line as well and increase their dominance. Moving on to some extra things that were mentioned in the earnings call with regards to subscriptions. It is now a $15 billion business annually. YouTube is the key driver of our subscription revenue. Not surprised there. YouTube Music, Premium, having some real momentum. Now, I don't think the majority of YouTube users will be premium users, but I do think that over time, people will just say enough ads. I'm happy to pay a fee per year to stop seeing ads, to watch videos without advertising. And for Google, for YouTube, this is just an increase in revenue with nice margins. Moving on to Google One. This is growing very well. We are just about to cross 100 million subscribers. Again, subscription models here. We've seen this across the board with other competitors, with Apple as well. This is going to be a huge success and a driver of increased revenue and increased profits. Moving on to a bet that if successful can generate millions, if not billions of dollars in future profits, and that's Waymo. So Waymo, which is deeply focused on safety, reached over 1 million fully autonomous ride-hailing trips. Congrats on that milestone. Lastly, here's something to note for 2024. In 2024, they expect investment in CapEx will be notably larger than in 2023, but rest assured, revenue will increase faster than CapEx. And so we've reached the earnings report for those of you that missed that. So revenue increased 13% year over year, or compared to 2022 to the whole 2023, that increased 9% year over year. Operating income, operating margin for, let's say, 27% for 2023 last quarter. For the whole year, a bit of the same. Net income was $20.68 billion, huge increase from the $13.62 billion in the same quarter in 2022. Diluted earnings per share up close to 60% year over year to $1.64. Now, with regards to the different segments here, Google Search and others over $84 billion, YouTube Ads $9.2 billion, Google Network $8.29 billion, and so Google Advertising as a whole $65.51 billion. Yes, it did miss the estimates by a little bit, and maybe that's also one of the reasons why the stock took a hit. In my opinion, didn't make that much sense. Small hit, but still the important segments here have outperformed. Google Cloud, $9.19 billion. And if we look at the operating income for each segment here, Google Cloud reaccelerating, by the way, top and bottom line, now $864 million. Google Services, $26.73 billion. And so overall total income from operations, $23.69 billion. But here they do talk about reductions in the workforce and office spaces, and so they have to pay severance and related taxes of a couple of billions of dollars. Now, overall, of course, it's never nice to see layoffs and things like that, but in my opinion, for a company like Alphabet, I don't really think they've done enough cost cuts compared to all the other big tech companies. So maybe throughout 2024, more cost cuts, more job cuts will occur. I don't know. But for a company of that size that is supposed to be extremely tech oriented, I don't think they've done enough to be leaner, faster growing, and more profitable with regards to what the others have done. That's just my opinion. Of course, I do not wish for people to be unemployed, but if we purely compare it from an investment standpoint, they haven't really done enough. And so last thing here is the graph. One stock, one share will cost you $142.38 right now. This is on the weekly. On the daily, yes, we were a bit overbought at $152. So maybe that's also one other reason why the stock dropped, even though the report was pretty solid. Currently, this is an area where we've been in the past and actually got rejected a couple of times. Let's see if this time this can hold and stay as a support line. If you want to look at better opportunities, the 200-day moving average sits at just under $130. If it reaches that area, which previously it did rebound around that 200-day moving average, so if it reached that area, I do think this might be an excellent opportunity. So overall, you're getting a super strong, very, very profitable company that is buying back an insane amount of shares, that is becoming more profitable over time, that is still growing. Yes, there are some things that they have to do better. Yes, maybe the CEO isn't the best man for the job to lead this incredible company into the future of AI capabilities. Maybe Sergey will have to come back. Maybe Larry would have to come back. I don't know. But those are all the, let's say, options out there. You've got the good, the bad, and the not so ugly in this video. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.